I would like to welcome now to the stage Parvinder Thiara. He is the founder and CIO of Athenor Capital. Parvinder graduated summa cum laude with a BA in chemistry from Harvard College, same, where he was elected to Phi Beta Kappa as a member of the Junior 24. I don't know what that is, but it sounds maybe not as good as Senior 24, I don't know. He subsequently earned an MSc in theoretical chemistry from Oxford as a Rhodes Scholar, which theoretically I did as well. And Parvinder co-authored 4 scientific papers during his research career, which I significantly outdid because I rolled countless papers. He worked at D.E. Shaw for 8 years before setting up Athenor. I think that's plenty for the intro. Please give it up for Parvinder Thiara, everybody. Yeah.
Good morning, everyone. I'm Parvinder Thiara, and I'm the CIO of Athenor Capital. By way of a little background, the name of our firm is a callback to my days as a chemist. And Athenor is the never-ending furnace that alchemists use to generate steady heat. And that's how we like to think about our investing process. We're an alpha-oriented, opportunistic investment firm that utilizes the traditional tools of macro to identify and exploit relative value opportunities. We spend a lot of time thinking about single-name equities and commodities, but we look across all asset classes and geographies. And the trade I'm going to talk to you about today involves the rate markets. Now let me take you back to last year for a second. Cash outperforms all asset classes for the first time in almost a century. Hedge funds put up some of their worst numbers outside of 2008. Equity markets suffer one of the steepest monthly drops in the post-war era. 2018 was unequivocally one of the most grueling years for investors in recent memory. So what happened? In one word, liquidity. Let's look at it from a macro perspective. This graph depicts the extent to which financial conditions tightened in 2018. After an extended era of ultra-loose monetary policy, rate hikes, the Fed's balance sheet unwind, a strengthening dollar, and rapidly fading fiscal stimulus combined to deliver an exceptionally potent dose of tightening that forced financial markets to reset and rein in leverage in the fourth quarter. Now fast forward a few short months, and 2019 is off to one of the best starts ever for risk assets. Why? Again, it all comes back to liquidity. In late December, the Fed, boxed in by its own policy of forward guidance, delivered a rate hike amidst the backdrop of collapsing markets and rapidly deteriorating financial conditions. Chairman Powell put on a bravely hawkish face at his late December presser. But markets quickly called his bluff, and by the first week of January, Powell folded. And he has delivered more dovish messaging ever since, an about-face to rival even the resurrection of Jon Snow. This dovish shift, now known as the Powell pivot, is in my opinion the single most important event for markets this year. Combined with the dovish Draghi, central bankers around the world are telling us that they want real rates to go back down. Chinese fiscal stimulus working its way through the system only adds to the positive second derivative with respect to liquidity. Bond markets have clearly responded to this dynamic. Hikes have been priced out almost universally, and rate cuts are odds-on in many markets. But looking at this graph, there is one notable exception: Brazil. If there is one graph from this presentation that I want you to remember, it's this one. Here we have market-implied policy rate changes over the next 2 years across major EM and DM countries. Which one looks different from the rest? Brazil. Brazil sticks out like a sore thumb. This sort of disconnect is precisely the sort of thing that gets us excited. We're always looking for situations where different markets are pricing in divergent expectations. And that's what I think we have here. In this case, we believe the evidence makes a compelling argument to receive Brazilian rates hedged by shorting the currency. So why is Brazil such an outlier? Dollar liquidity tightening is usually the biggest systemic risk to EM rate positions, but that's clearly not the case here today based off what other rate markets are saying. Could it be about booming local growth or accelerating inflation specific to Brazil that might justify rapidly tightening monetary policy? Nope. From a fundamental perspective, this picture makes no sense. Brazil went through a painful current account adjustment a few years ago and is still in the process of coming out of what was effectively an economic depression. This is not a country that needs one of the most aggressive tightening cycles globally. This is not a country vulnerable to current account shocks, and this is not a country that should be such an outlier globally with respect to monetary policy. Domestically, the Brazilian economy cannot withstand the policy tightening that markets are pricing in. The adjustment that Brazil has made over the past 4 years to get its balance of payments in order have left economic activity at deeply depressed levels. After experiencing the worst GDP drawdown since the early 1990s, real output is still 5% below its previous peak. At the current pace of growth, which remember, is supported by the stimulative policy stance that we see today, it'll take over 3 years for Brazil to reach the previous peak. This means there's a tremendous amount of slack in the economy, and inflationary pressures should remain subdued for an extended period of time. Now, as you can see in this graph, domestically driven price growth is low, with core inflation bouncing around the lower end of the central bank's target band. If anything, I would argue that domestic conditions justify easing rather than tightening. I actually think the probability of a rate cut is higher than the probability of an imminent rate hike in Brazil. And yet there's a tremendous margin of safety in receiving rates here. To lose money, the central bank needs to hike rates more than the market is currently pricing in. And as you can see here, the market is currently pricing in one of the most aggressive hiking cycles in Brazil's history. Turning to external conditions, note that Brazil is no longer acutely vulnerable to a balance of payments shock. They just went through a current account crisis, and the economy has already rebalanced. While Brazil does have large internal imbalances generated by the public sector, these are now almost fully supported by high levels of domestic private savings. Little net new funding is needed from foreigners. In addition to Brazil's relatively comfortable balance of payments positions, the central bank has a lot of firepower to smooth currency weakness. Its cash reserves are almost $400 billion, an ample amount to cover the country's net funding needs, as well as large financial outflows, should Brazil experience liquidity pressure. This is not Argentina. This is not Turkey. If they do run into currency weakness, they won't need to hike rates to defend the currency. They'll simply intervene in size, something that they have shown the willingness to do time and time again. So if the risk premium in rate markets is not about fundamentals, what about the politics? One of the biggest stories in EM has been Brazil's election of the right-wing tropical Trump, Jair Bolsonaro. Investors have generally cheered his economic agenda, spearheaded by Paulo Guedes, a die-hard free market economist and the co-founder of investment bank BTG Pactual. However, corruption scandals, administration infighting, and a penchant for nasty tweets have led the market to obsess over the political risks associated with pension reform, a key pillar of Bolsonaro's economic reform agenda. Now, I'd say two things on the politics. First, Bolsonaro is actually the Trump of the tropics. He wants lower rates, pushes for it, and tweets about it, which is apparently how all policy change starts these days. Second, markets have given us a reasonably cheap opportunity to hedge the political tail risk. The foreign exchange markets stand out to me as both spot price action and option implied probabilities suggest far more benign risk premiums than rate markets, making a BRL short relatively inexpensive. So in summary, Brazil is currently pricing in some of the most aggressive rate hikes globally, when in reality the fundamentals justify a far slower path towards normalization. Brazil is not a country that needs one of the most aggressive tightening cycles globally. Brazil is not a country particularly vulnerable to current account shocks. And Brazil is not a country that should be such a global outlier with respect to monetary policy. And if that is what you believe, you should receive. If you want to make some money so you can donate that to Sohn, here's what I want you to do. Receive front-end Brazilian rates and buy dollar calls BRL puts. Good luck, and thank you, everyone.